Hey everybody, it's your favorite gentleman, Marcus Norman, for round two of today's shows of Gentleman Style Podcast shows. Today we have a dynamic speaker. This man is an absolute powerhouse. You want to stay tuned for this one. This is going to dive deep into not necessarily an ancient secret, but a secret nonetheless that more and more people need to find out about, more and more people need to discover about how to pay off your home, your mortgage in 5 to 7 years. Stay tuned, stay with us. You won't want to miss a second of this dynamic speaker. Here we go. Hey everybody, this is your favorite gentleman, Marcus Norman of Gentleman Style Podcast Show. Today we have the incredible guest, Mr. Michael Lush. This man is absolutely phenomenal. This man, his resume is extensive. Mr. Lush woke up one day and bumped into a wealthy mentor who showed him what was wrong with what we were doing in society and what people were doing, what he was doing in having a 15-year, 30-year mortgage. A lot of us have a mortgage, and especially now, this is a topic that needs to be discussed. And Mr. Michael is a trained, seasoned expert. He has the company, he has the infrastructure, he has the knowledge to help us with come to a better understanding and find out the secret, the real secret that bankers and lenders for decades didn't want you to know about. So help me welcome to the stage the incredible, the amazing Mr. Michael Lush. Welcome to the Gentleman Style Podcast Show, sir.
That's one of the best introductions I've ever had. And I played college basketball.
It's all you, sir. It's all you. We wanted to shine the spotlight on you. Your resume is extensive.
It is. Absolutely. It was something that, pretty much right out of college. I had a buddy that was a year ahead of me in college that got into the mortgage industry. And he's like, I think you'd be good at this. And I was like, I don't even know what a mortgage is. I've never had one. I don't own a home. How am I going to be good at this? And the rest is history. Yeah, I got into the mortgage industry and rose the ranks. And come to find out, it was a wealthy mentor of mine who owned a fund. Or I should say managed the hedge fund. He was the principal manager of the hedge fund and shared the secret with me for about 10 or 15 minutes. And that was a tailspin from there. That was back in 2009. And here in 2021, and I'm anti-mortgage.
Anti-mortgage. That makes sense. I think everybody hates cutting that check every single month. I hate stroking that check. It's like, didn't I pay you last month?
Right. Yeah. Next month won't be any different, will it?
No, but here you are to spill the tea on how we can maybe not change next month, but maybe change our year. And so that's what we need you to help us get to a better place and better understanding. But before we go into that, I have to ask, successful people have successful habits, things that they do day in, day out, every single day. What is it that you do that has led to your success, business or personally, that really sets the tone for your day?
Oh, that's easy. I start my day with prayer. First thing I do, get out of bed, whether it be in the shower, brush my teeth, maybe not out loud. Sometimes it's out loud, but, speaking the affirmations, but also, praying to my God and, one, asking him for forgiveness, but also asking him to continue to bless me the way that he has, and to be a good steward of those blessings. I think a lot of times, we can be blessed as individuals, but if you're not prepared for it or ready for it, we're not good stewards of those blessings. So that's one of the main focuses of my prayer is, Lord, if you're going to bless me and continue to bless me, I just ask wisdom and guidance that I take those blessings and bestow them amongst other folks as well.
Amen. So, Mr. Lush, thank you for saying that. And that's absolutely true. It is absolutely true. Morning prayer. I remember this scripture not the scripture, but the context of what this pastor has said is every morning when you start, before you tackle the day, before you start your day, you need to adorn yourself with the armor of God. And the armor of God is his word. getting in scripture and talking to him and spending time with him. And that is the armor. No warrior, no sentry, no centurion goes into battle without their armor, their proper gear. So it's the same thing. So thank you for saying that.
Yeah, absolutely. And in fact, it's something that folks that follow me or, become a student of mine will quickly understand, and I'm unapologetic about it. So one of the things I'm most proud about when I built this program and company is to share the gospel. And we, on average, share the gospel with 5 to 6 individuals every single day automatically. So sometimes we're sitting down with, some of the Christians are like, I'm a better Christian than you. What have you done? And I never want to brag about, being a better Christian. That's judgmental. But, having those conversations that, they talk about this and that, and then they just assume, you've got a beard, you talk about a neck, and you're probably not sharing the gospel as much as you should. And that's when I speak up. So it's funny you should ask, because I've been doing that for 7 years, and I share it with 5 to 6 individuals every single day. I took a day off. And I do that through my course, which is an easy way to do it. So it may be more than 5 or 6. I stumble across people, but through my course and through my teachings, people are going to find the gospel.
Love it. Love it. Love it. Michael Lush, y'all, the incredible Michael Lush. And did I forget to mention in that extensive resume, that bio, he's also very humble. So that's powerful. That's absolutely powerful. Sir, in your course, you brought it up. Since you brought it up, can you spill some tea on what people should expect going into the course? So how can we pay off our mortgage? How can I pay off my mortgage, my 30-year mortgage, in 5 to 7 years? That's impossible. That's absolutely impossible.
Yeah, and that's usually that is still to this day, 7 years later, and thousands of clients later. I've traveled the country and doing things like this on a daily basis. That's still the biggest stumbling block for us, spreading our message and spreading the message of what our service is it sounds too good to be true, and it's not. And I think what we have to do is really go back to history and understand finances of how the mortgage came to be in this country. Now, in other countries, it's not the same. For instance, if you go to Australia, 80 to 85% of Australia each is what they do this in high school. In 13. So prior to 13, what I'm talking about was very normal. A mortgage was an open-end product, meaning money could move in and out freely, 24/7. It was very popular amongst farmers. So I've got equipment I need to buy, so I need to borrow money against my farm. You got the money the same day. You sold your crops. Guess what? That money goes back into your mortgage the same day. So it was a simple interest open-end instrument. However, 1913, that changed the game forever. So can you guess what happened in 1913 that may have changed the game forever?
The market crash, the stock market crash.
A lot of people say war. It was the institution of the Federal Reserve. So the Federal Reserve is neither federal nor is it a reserve. But what it is it's a backstop for banks to execute what's called fractional reserve lending. So fractional reserve lending means for every dollar you put into a bank account, they have 10 to lend out. Now, some credit unions have a higher ratio than that. They lend out 15 to every dollar. But once the banks got a hold of this magic trick, as you call it, they got together and was like, wow, what do we need? We need more deposits. Because think about it, Marcus. If you gave me $1 bill and I snapped my fingers and turned it into a 15, handed it to you, what's my next question? Or what's your next question? Hey, let me go get $100 bill and give it to you, right? Let me give you as many as possible. So that's what the banks did. They wanted to grow core deposits. They wanted more people to deposit money into their checking and savings accounts because they could execute fractional reserve lending. Now, let me go back a bit. Can you guess what mortgage is, what the root word of mortgage means? It's Old French. It means death pledge. So it's a contract for death. That's what mortality in Old French means, and engage is a contract or certificate. So it really is a death pledge. So back to the fractional reserve lending, banks got together and said, we need to grow core deposits. So let's look at how consumers are actually, where their money is flowing. And at the time, their money was flowing in and out of their mortgage or their estate. So the banks got together and changed one simple thing. They made a mortgage closed-end product, meaning money could go in freely, but it could not come out freely. So think of it today. If we put all of our money into a mortgage, everything we make, that's fine. The balance goes down. But then what happens when we want to pay our bills? Utilities, gas, groceries, eating out, vacation. We can't. We either have to refinance, which is costly, or we have to sell, which is not ideal. So that's the only way to access the overpayment that you made to a mortgage. So by making it a closed-end product where money can only go in and not come out, it forces the consumer to only put some of their money in mortgage, right? Not all of it. So what are they going to do with the leftover money? Put it under the mattress or put it in the bank accounts, the checking and savings accounts, which grow core deposits. And then now they get to lend out even more and more money. So a lot of folks thought that the primary goal was to force you to pay less. That was actually a byproduct of making it a closed-end product. And now what do you see? You see other products that are similar. Car loans, student loans, private loans, personal loans. They're installment loans. They want to make them closed-end products because they're the least efficient type to pay off. That's where a HELOC comes in. So a HELOC, and what I teach is actually going back to basics of what we used to do as Americans prior to 1913. So a HELOC is a simple interest, open line of credit. So let's say you start off with a $300,000 line of credit. You put all of your money in, you're forcing the balance down. Now, on a line of credit, just like a credit card, what happens the next day? It recomputes what the daily balance is and what the daily interest charge should be to you. On a mortgage, it's compounding. So they do that months later. But on a line of credit, they do it every single day automatically for free. Time to pay your bills. Now you can pay your bills directly out of the home equity line of credit. Because a lot of these HELOCs come with debit cards, online bill pay. I mean, it's just as liquid as having a checking account. And some of these banks have mechanisms that make the HELOC no different than a checking account. You get checks on it. You get online bill pay, debit cards, things of that nature. So instead of putting your money into a checking account, where the rate of on that checking account doesn't even keep up with the cost of inflation, especially today, right? We have almost hyperinflation. So your money sitting in there earning 0.25% is far less than the rise of cost of goods and services. So why not take that money and put it into an instrument where you're 100% liquid 24/7? If you need it 5 minutes later, boom. It's a simple stroke on your board or on your phone to get money back out. So by doing so, you're far more efficient because it's recasting every single day for free. And that's how thousands of our clients are paying their home off on average 5 years. Now I've got one that 10 months. That was the fastest. Now I've got some that's slow is 12 years. But we're projecting 12 years if their income never changes, if their expenses never change. However, if income goes up, because hopefully in 12 years we make more money, right? So if you make more money, that time frame shrinks. So yeah, and we've got a calculator on our website at replaceyourmortgage.com. It's just simply HELOC calculator. You can go in there, put in your finances. You can even say, what if rates skyrocket, and put that in there and see what it does for you. A lot of people are shocked that even if interest rates, they're still far more efficient and pay far less interest on the HELOC than they would on the mortgage. Now, all while, let's say you're paying it down, because here's the antithesis of it. You know, your planners, some, not all, but some financial planners is, well, we should invest too. Wholeheartedly agree. So why not use your HELOC as a great storage vessel, right? It's that just stores cash until you deploy it to earn higher interest, called arbitrage. No different than a bank. We got to start thinking like banks do, right? So a HELOC is a great place to store cash until you need it, still reducing the balance, and which also reduces the time, which massively reduces the amount of interest that you pay. So is it a product for everybody? Absolutely not. It isn't. Living paycheck to paycheck, don't get a HELOC. This isn't for you. But if you are cash flow positive, absolutely. Get a home equity line of credit because it's far more efficient than a mortgage. And what you'll find is those individuals that you emulate and that are your mentors, they're already doing it. They're already doing this.
Wow. We have to unpack that. That was a lot of information. We have one quick commercial break. We'll be right back. Y'all stay tuned. Stay with us. Don't go anywhere. We'll be right back, bringing back Mr. Michael Lush. Stay with us. See you soon. Good day, podcast listeners. This is your boy, Marcus Norman of Gentleman Style Podcast Show. I wanted to let you guys know that we will be rolling out a new feature and adding a join sponsor button next to the subscriber button here at the bottom of your screen. Once you click the button, it will display 3 membership levels: Gentleman Gentry, which is our entry level; Duke Duchess, which is our season level; and the Emperor and Empress, which is our most sophisticated level, which you will receive unique perks and benefits at each differing level and gain access to our community tab. We will also be sharing polls, upcoming events, and interviews, as well as receive feedback from our sponsors directly. Your support helps me find new and exciting guests to bring to the stage live. Well, in order to get the higher end speakers, it requires, you guessed it, money. So thank you for tuning in to my channel. And if becoming a sponsor sounds good to you, then select the join button below and choose your desired sponsor level. Let's continue to grow and serve the future of generations of men and women to come. Love you guys. Bye. Welcome back, y'all. This is the Gentleman Style Podcast Show. We have the incredible, the amazing, the big thinking Mr. Michael Lush. This man absolutely is a game changer. He just broke down, if you missed it, he just broke down how a HELOC, a home equity line of credit, is a better financial product, better than your debit card, better than your checking account, better than your savings account. And it's a much better product, and how to effectively use it, which we are about to dissect, how to effectively use it to pay off your mortgage in 5 to 7 years. So, Mr. Lush, you dropped a bomb just now, and it is an absolute game changer. And so why not do the same? First off, this isn't a scam, y'all. This is real deal. First off, why not use a different financial product? Because just like a HELOC, a line of credit, why not use a regular line of credit? Or why not use a credit card to accomplish the same thing, right? Can we, or can we not do that?
You can, and not. The issue with a mortgage, though, is it segregates your income. So when you segregate your income, you lose efficiency. So some companies out there will say, well, get a home equity line of credit in second lien position. And then that way you have your mortgage, and then you use a HELOC in second lien position to kind of dump that equity into your mortgage and then rinse and repeat. It's a great strategy. However, there are some risks associated with it. One, it's less efficient because you still have segregation of income. And what I mean by that is you still have money going towards the mortgage that is not getting applied towards the HELOC, right? So when you do that, your HELOC is less efficient. And most folks never thought to ask. And this, again, it just came to me as a banker back in 2009. I'm like, well, that we're thinking of it in second lien position. Why not in first lien position? Let's do it in first lien position. The answer is yes. Think about it. If you're a bank, especially you go through 2008 and 2009, and you're in second lien position, you're pretty nervous, right? Because home values are declining, people are foreclosing. And if I'm the bank and I'm sitting in second lien position behind a mortgage holder, there's no guarantee that I'm getting paid off or anything for that matter. So why not ask the bank, can I be in first lien position? And a lot of bankers don't even realize they have the product to be in first lien position. So what we're talking about is literally refinancing your mortgage and changing the mortgage into a home equity line of credit, which doesn't take a lot of equity, basically 10% equity. So let's say you have a $400,000 home and you owe $360,000 on your mortgage. A lot of folks are like, well, how am I going to take $40,000 to pay off my $60,000 mortgage? You're not messing with the $40,000. All you're doing is changing the debt instrument, which is your mortgage, and changing it to a home equity line of credit to refinance. So a lot of folks will refinance to an FH or from an FHA loan to a conventional loan to get rid of mortgage insurance. Well, a home equity line of credit, you can do the exact same thing. No, speaking of mortgage insurance, HELOCs never have mortgage insurance, ever. So I don't care if you're borrowing 85 or 90% or even 95% of the value of your home, you never have mortgage insurance, which is something that is a complete waste of money. It does not protect you. Some people still to this day think that, oh, I'm paying insurance, I'm protected. No, you're not protected. The lender's protected. So obviously, if you're a bank, you're like, yeah, I want to be in first lien position. So in first lien position, you lower the risk to the bank. Therefore, it lowers the risk to yourself. So not only is first lien position more efficient, it's less risk too from freezing. So yeah, I mean, you could use a credit card and a HELOC, which is another thing that we teach. Well, a zero business line of credit so it doesn't impact your personal credit score, and use that to pay your bills while all of your income is going towards your home equity line of credit. And then once you get towards a max out, which is okay on a business line, because again, it's not reporting on your personal bureau, will then take your HELOC and pay off that line of credit, which is a credit card, and then rinse and repeat. And believe it or not, do that, you speed up the process another 15 to 20%. So let's say you're on pace to pay your home off in 5 years just using the HELOC. You use that offset account, is what I call it. You knock off another year. It may seem like a big deal, but that's a lot of interest saved. Not to mention you get all the rewards points. So when I fly for free. When I rent a car for free. When I stay at a hotel, I stay at a hotel for free. Why? Because I'm a good steward of my money, and I'm not using it to buy boats. I'm not using it to buy watches and things of that nature. I'm sticking with inside of my budget. So that's an important part. This does not change. You need to be financially disciplined. This isn't a magical pill. This isn't a magical elixir. The only way to pay down principal is to pay down principal. And that requires you being cash flow positive, and it requires you being on a budget. So getting these things, you have to break bad habits that a lot of people have, a lot of Americans have, bad habits of putting things on debt that is not an asset instead of a liability. So, but you can absolutely use these tools to crush your debt and invest.
That's major. And that's major. So I have to ask a question, because a HELOC and a credit card, my credit card interest rate fluctuates. So what if interest rates go up, right? We're printing money faster than we can spend it. There's cash being infused in the economy. The Federal Reserve announced that although interest rates are lowering up, keeping them low, interest rates are starting to peak, and interest rates are starting to turn a corner, especially in the real estate market. So what do I do when interest rates go up on my credit card or my HELOC? Is this still an effective method?
Yeah, if you're cash flow positive. So again, I've calculator on replaceyourmortgage.com. I'm on my phone. If I were on my laptop, I'd screen share and kind of show you when you go to replaceyourmortgage.com and go to the HELOC calculator. We have a tab in there that says rate increase change per. And let's say, like for instance, my example, I'm cash flow positive enough that I can pay my home off every 17 years. Now, if rates go up on me, let's say a half a point or a point, which is not going to happen, and we can get into economics here in a little bit, but interest rates are not going to skyrocket. That hasn't happened since 1981. So people are scared of it because it's 40 years ago. But if it did, because of my cash flow positivity, I'm attacking two things that are far more important than interest rate: time and balance. So for example, let's 30-year mortgage at 3%, same balance as the 15-year at 5%. Now, granted, you get a interest rate break if you go to a shorter term, but let's just say it was higher, right? Which one do you think you would pay more interest on? It's not the higher rate. It's the lower rate that you pay more interest on, because time is further out. 30-year term versus a 15-year term. Now, vice versa. Let's take a $100,000 mortgage at 3% and a $200,000 mortgage at 4%. Same time period. I don't care if it's 15 or 30. Which one do you think you're going to pay more interest on? The lower interest rate mortgage, because it's got to be. So we have to retrain the brain to think of time and balance are far more important than interest rate, because that's exactly what dictates how much interest you pay, is time and balance. And with the home equity line of credit, even if the interest rates are increasing, if you're cash flow positive, if you're living paycheck to paycheck and only making the minimum payments on a HELOC, it's not for you. Don't do it. But if you are cash flow positive, meaning you make more money than you spend, yes, the interest rates are hardly effective. It will change the calculator. You'll see, okay, instead of paying the home off in 60 months, interest rates go up a half a point every single year, depending on the person's 64 months. So it may change 4 months. Still better than a 10-year mortgage, still better than a 15-year mortgage, still better than obviously a 20 and a 30, but you're also liquid. That's the thing. The HELOC gives you the ability to have that confidence to put everything in there, because if a drop of a hat, you need that money, you have access to it. That's why less than 2% of Americans pay extra on their mortgage, because once they do, they don't have access to it unless they pay thousands of dollars to refinance or they sell the house. And again, neither one of them are ideal. Most HELOCs are free. You can get HELOCs for free. I'm talking title fees and all of that. So now there's also 3 types of HELOCs. Everyone thinks that a HELOC, and it is most predominantly a variable rate loan, meaning it's based on prime, it's based on LIBOR or T-bill, and the interest rates can fluctuate. I personally like the 6-month T-bill. Take a look at it today. It's sitting at 4 basis points, right? So I go get a HELOC from a lender or a bank based on the 6-month T-bill. Yeah, they're going to put margin in because they got to make money. I'm still sitting at 3%. How often is T-bill? We look at it over the last 2 years. It's done nothing but tank. You mentioned interest rates have gone up on mortgages. They have not gone up on HELOCs. And in fact, they've gone down. And I don't predict, and again, don't take my advice, watch other people like Schiff and all of that. That's where I get a lot of my information to, not exclusively Peter Schiff and not even mostly Peter Schiff. I'm just mentioning him as one of those hedge fund economist guys. Interest rates are probably not going to increase anytime soon. And if they do, it's going to be very minimal because we do have that debt. I mean, the Fed is already trying to make an excuse when it comes to inflation that, yes, we're in an inflationary period, but they feel it's transitory. So to now measure inflation on an average over a couple of years before they make a monetary policy change of increasing interest rates, because they don't want to pay higher payments on that debt either, just like we don't. But again, you've got a variable rate. You also have a fixed rate HELOC. There are HELOCs out there that have a fixed rate, meaning the rates don't change. Now, folks 2 years ago that got a fixed rate HELOC, they're not as happy as that had a variable rate HELOC because their interest rates went down. Therefore, they got more efficient, right? And then there's hybrid. Hybrid means you can have a portion of your HELOC that is fixed, so that debt interest charge on it doesn't change, and you can have a portion on it that's variable, meaning it does change. And sometimes it's only $90 to change one from a variable to a fixed rate HELOC. Lots of flexibility.
This is incredible. This is incredible. So I oftentimes have real estate investors on the show, and when they talk about buying real estate, can this strategy be implemented? You mentioned it earlier. Have to have positive cash flow. If you're living paycheck to paycheck, this strategy is not for you. This program is not for you. Tell us one thing: who's a prime candidate for your program? And two, are real estate investors, can they use this strategy for buying real estate?
Yeah, 60% of my audience and my clients are real estate investors. And I should say are either real estate investors or want to be real estate investors, or seeing that they want to be or need to be real estate investors. So I'll tackle that, and then I'll go back to the criteria of what it takes to be a client. So let's say you're a real estate investor and you've got a home worth $400,000 and you owe $200,000, and you can access, the additional $160,000, right? So you refinance your mortgage and get a $360,000 home equity line of credit. Here's another thing that's different about a HELOC than a mortgage. If you refinance your $200,000 mortgage to a $360,000 mortgage, you're paying principal and interest payment on the full $360,000 day one. On a home equity line of credit, you only pay interest on what you've used. So if you've got access to another $160,000 but haven't used it yet, you're only paying interest on the $200,000, not the $360,000, until you use it. Once you use it, yes, you're going to pay interest on it. But on a mortgage, it's a cash grab. Let me get it now. Now my payment went up, my interest went up, the interest cost went up. Maybe not the interest rate, but the interest cost went up because I've accessed that cash. I need to hurry up and deploy it and find something that's going to offset the interest cost as soon as possible because I'm paying it day one. On a HELOC, that's not the case. Even folks that have a free and clear home, get a HELOC. Get a HELOC at 90% of the value of your home. I'd rather have access to it and not need it than need it and not have access to it. Coronavirus is a great example, and I can share some client testimonials as far as what happened during coronavirus for my clients versus folks with a mortgage. But you're a real estate investor, $400,000 house, you owe $200,000, you get access to another $160,000. Does that mean you go buy one house for $160,000? No. What you do is you chop that $160,000 up into down payments on, let's say, your $100,000 rentals, right? 2-bedroom, 1-bath rentals, and they're $100,000 a piece. Well, you can put 20% down on a purchase money HELOC. So there are banks that will allow you to purchase with a HELOC, not a mortgage, with 20% down. So you chop up that $20,000, you can now go buy, 8 properties. 8 properties, also financed on a HELOC. So instead of being a part-time real estate investor, you can now become a mogul. So now you've got access to 8 properties, which is It's better to have 8 properties than 2 because of vacancies or, damage and things. I'd rather have 10, 15, 20 properties that are rented out at 80 to 90% capacity as opposed to having 2 properties. And every now and then I've got to properties and I've got a cash flow disruption. So you can use the HELOC to invest in real estate. Now, back to the first question is, who's this for? Banks are very low to HELOCs. However, I would not recommend this to anyone who has less than a 660 credit score. If you have less than a 660, typically it means there's some type of financial discipline that they lack. They miss payments on something or they're maxed out on something, and they need further education before they proceed with this. So 660 plus credit score. Secondly, 10%. So if you have a $100,000 home and you owe 90, you're in good shape. You can do this. Or if it's a $200,000 property and you owe 180 and so on, 90% of the value of your home, you got 10% equity, then that's importantly, I hate to reiterate this and beat it like a dead horse, but cash flow positivity. You have to make more money than you spend. You have to have already mastered your budget. If you have, go talk to Dave Ramsey. If you have, let's graduate from baby steps. Let's move on to something more strategic and more adult.
There it is. There it is. The magic. You all, this is phenomenal. We have one more quick commercial break. You guys don't go anywhere. Stay tuned. Stay with us. Stay engaged. We'll be right back.
Are you a local business looking to offer your customers easy access to cash without having to travel miles? We're here to help. At Norman Legacy Investments, we provide free ATMs with free installation that provide a suitable investment for your business. Even better, we offer you some profit sharing and handle everything from start to finish. Just reach out to us today to schedule a free consultation.
We are back, y'all. We have the incredible, the amazing Mr. Michael Lush. This man is phenomenal. He is breaking down the tea on how to do better business and take not only our personal lives, but even our real estate business to the next level. And using his strategy, his proven strategy to teach us, he goes through step by step in his course on his website, Pay Off Your Mortgage, replaceyourmortgage.com. And he is teaching this strategy. He's going to take you hand by hand with his team and his company. He's going to walk you through the steps to pay off your mortgage in 5 to 7 years. And if you missed that, scroll back, go back, or tune in, or click the link in the description below. This is powerful news. Sir, why aren't banks doing this? Why aren't financial advisors teaching this, right? Why am I sitting here paying a 30-year mortgage? I mean, I know people who rent and they're in their 50s and are now considering getting a mortgage at 50 years old. Where have you been?
Yeah. I asked myself the same question. I wish I'd have known this prior to 2009 because, as someone who was in the mortgage business for so long, I wrote thousands of mortgage applications. So who do you think it was, the first people that I called and said, hold up, I believe we've made a mistake? It was all of those, right? I had to write the wrong one family at a time. So I wish I'd have known it. It's funny because in 2004 or 2003, I bought a house in Charlotte, North Carolina. At the time, it was primary residence. And I had a buddy that used to work for me, and he went to work for another company, and they had a first lien HELOC. Now, he didn't know enough to try to educate me on the subject. He's like, no, somebody told me this is what you need to do. And I closed on it. I did, but I got scared within 2 or 3 months after getting it and getting in the home. I was like, I don't know, man, this is a variable rate. And I refinanced it to a more, and had I had the proper education, I wouldn't have went through the financial turmoil that I did in 2008. Went through bankruptcy, foreclosure, cars repossessed, and all that. I wouldn't have. I would have been able to weather the storm, which kind of brings me back to a point I made earlier and wanted to expand on is how is this beneficial in times of distress? Let's say coronavirus. Because so far, all we've talked about is this is a great strategy, right? But what if you need to survive? So a lot of these HELOCs, again, let's say you've got a $400,000 house and you've paid down on your line of credit. You're 2 years in. And I've got thousands of clients that have been doing this with me since 2014. And then we have coronavirus. Maybe lose a spouse, lose income. We've had, several of those where income went down, they were furloughed, and they were on a HELOC that they had been paying into. But remember me saying that you have access to your equity 24/7? You don't on a mortgage, right? So those folks that had a loss of income, if they go back to get access to that equity, one, it's going to take 30 or 45 days, but they got approved income, right? Well, mortgage is now too nervous. They're like, no, sorry, your income went down. We can't approve you for that. So you're stuck with the mortgage you have. With a HELOC, you've got access to it 24/7. So let's say you've got a $300,000 line that you paid down to $200,000. A lot of these HELOCs, you don't have to make a payment to. They get onto the balance. So let's say you have a loss of income. Okay, well, I don't have to worry about the HELOC because I've got $100,000 on my line. So if I don't make a payment, it's going to just increase my balance. That's not ideal. That's not something you want to happen, but you also don't want foreclosure to happen either. So you can mechanize your HELOC to pay itself. It can cannibalize itself. You can actually take it a step further of not only not making a payment, you can mechanize your HELOC to pay you supplemental income. Now, if you only have access to $100,000, depending on what your expenses are, that's not going to last forever, right? So that's why I tell folks, get as big of a line of credit as possible. Even if you're not going to use it, you never know when things like this can happen. And it's funny because, now I'm part of the banking industry and I own a minority share of a publicly or joint venture of a publicly traded bank. And I've been in the boardrooms with these hedge funds, the hedge funds that buy up this paper on the secondary market. And from 2009 to 2014, there was this one major hedge fund that bought tons of this paper. And that was during the mortgage meltdown, lots of foreclosures and whatnot, and foreclosure rate was north of 5%. The foreclosure rate or default rate on home equity lines of credit and first lien position were less or 115 times lower than mortgages because of what I just explained to you. So when times got tough, they didn't refinance. They just used their equity line to weather the storm, to pay the bills, to give them supplemental income. And in fact, one hedge fund had 2,416 transactions of position HELOCs. And to this day, they've never had a single default. No one's been late on it. It's because it can feed itself. So there's advantages in times of thriving, massive advantages of paying it off early, but in times that you need to survive, there's an advantage there too.
And that makes sense. And that makes perfect sense, right? Because you said it earlier. The biggest thing that we need, the biggest thing that we're looking for, that's what people needed during this recession. They needed time. And having that HELOC in place and having that cushion, that $100,000 on that $300,000 home line of credit gives you time. It gives you time to, if you lost your job, it gives you time to find a new one. It gives you time to make some life changes, to make some life adjustments. But like you said, it bought you time. So you don't have to worry about foreclosure. You can set yourself up. You set your HELOC up to just increase and pay your bills and pay your expenses and get what you need. But it gives you time. A lot of people didn't have time, especially people who live paycheck to paycheck. 1 week, we're 2 weeks away from financial disruption, but now you have that time. So thank you for saying that. Thank you for shining some light. Powerful.
And nothing really exposed us more than COVID-19. I mean, COVID-19 exposed a lot of folks that were living paycheck to paycheck, and we don't have to. That was something I did. I remember prior to 2008, both me and my wife were in the mortgage industry, and I was a top senior manager for a company, publicly traded company at the time. She was a top loan officer for her company. My income was high. It was really high. But I didn't have the financial discipline. So I was really into cars. I had the Escalade, I had the Denali, I had a four-wheeler because I'm a redneck. I had a motorcycle redneck. I had all these things, right? She had a nice car. She had BMW and all of that. So, when the mortgage industry came to a screeching halt, although we were making quite a bit of money for somebody in the early 20s, we were paycheck to paycheck and we got caught with our pants down. So we don't have to do that. And that, again, that's why I go back to budgeting is that's your foundation. You have to get your house in order, understand your finances, understand what's coming in, understand what's going out. And if you do that, you can master this. It's very simple. And I actually love doing this with investing. So I invest out of my HELOC. So for instance, the bank that I bought into, Where do you think I got the funds to buy into the bank? Came from my HELOC. And 18 months later, I was getting dividends. Single, still do to this day. I get dividends. And I've not only paid back what I borrowed from my HELOC to invest in that, but then some. I've actually almost doubled it at this point in 18 months. So you can buy real estate. You can get into insurance, crypto if you want to, day trading, anything that you want. It's a vessel to store cash if you want to invest. Now, if you're, depending on your life cycle, you're like, you know what? I just want to be debt free. No problem. This is great for you.
Absolutely. You have a book. We have to touch on this book. Where can people get access to this book? How can they find it? Where can it be bought? And what should people expect to get out of this book? Is it the same great knowledge?
It's this knowledge, but it has lots of graphics on it that go through it math. You know, one of our slogans is it's math, not magic, because I get it. It's too good to be true. When it was explained to me, I spent a year with a CPA and an actuary trying to disprove this, because proving it right meant what I was doing in the mortgage industry was wrong. And being a moral person, I didn't want to. It was funny because he told me, he said, honestly, Michael, what you're doing, hedge fund manager, he said, what you're doing is you're selling financial crack to middle America. That's what a mortgage is. So that didn't sit well with me, and I didn't feel good about it. So I actually tried to disprove this. And it's just a simple math equation. We're not even talking hard math. We're talking third grade math. This is really simple math. So the book is going to break down all of those equations and graphs and show you why it works versus a mortgage not working, and why a mortgage was set up for you to fail. It's set up to segregate your income. It's set up to separate you from your cash so that you'll deposit in a bank. So the book goes through that in greater detail, but I don't want to buy it. I just want to give it to you. So if you go to our website, replaceyourmortgage.com, you go to the bottom, you can download the book for free. Now, if you want to pay Amazon and go to Amazon and get the hard copy, that's fine. You can do it. Some people want the thump factor. Go to my website. I'd love to give it to you for free. I just want to share this information.
Wow. There you have it, y'all. A free book. Replace Your Mortgage. All the numbers, all the details, all the facts for free by Mr. Michael Lush and his team. Sir, what would you say if you had any one more nugget? You've dropped nuggets throughout this whole show. If you had one more nugget to give to that young man, that young woman on the fence wanting to get started, what would you say to them today, right now?
Especially if they're young. I just had a sister who's 18 years old, attended her graduation party yesterday. You know, we all know graduation, you expect to get money, right? Well, we did. So we wrote her a check, and I wrote down the mathematical, what it would look like for her to retire in 50 years. And, you know, she babysits and has some odd jobs here and there and whatnot. So she probably earns $5,000 to $6,000 a year babysitting and all of her odd jobs, but that's enough to invest $200 a month. And I showed her that in 9 years, if she invested $200 a month in 9 years, and it stopped after that. You know, when you're 27 years old, 28 years old, and you stop investing, it's impossible at the age of 50 to 55 not to retire a multimillionaire. So time is of the essence. You know, being 42, man, I wish I could rewind the clock, but I can't. So I got to make up for lost time, right? So investing and it's not just investing money, it's investing in yourself. I spend more money investing in myself, coaching programs, people to coach me, mentors, physical endurance challenges, hire a coach. I invest in myself. I want to pour in myself. If you invest in yourself, have the mindset that I just need to pour. I need to be a sponge for knowledge and pour into myself. There is no better investment in this world than investing in your mind, because from here, it controls everything else. I was a college athlete that had some heart issues, and after college, fell off the wagon as far as working out and just having that competitive spirit. But then I went through a coaching program. It changed my mind. In my mind, I realized the mind is telling me that I'm far more capable of what I'm putting out. When it comes to running, I wasn't a runner. Now, I was a sprinter. I could sprint. I could do 100 yards. I could do 200 yards. But I didn't want to run 30, 40, 50 miles because it was painful. And what I learned through the process is that your mind is telling you that's your comfort zone. You've been operating in these two zones, and that is your comfort zone. You get outside of it, one way or the other, your brain's telling you, nope, don't do this. Something bad's going to happen. Your brain's actually lying to you. That's not true. And it's because, I went through Hell Week out in Southern California. And the first night was tough on me. Went through. I was vomiting on myself. Actually fainted while I was running and bumped my head, my knees, my ankles, and had one of my brothers kind of carrying me. And the goal is, hey, you've got to keep going. We've got to keep moving. And eventually you just break through that barrier because my brain's like, I'm going to die. And in fact, chugging water, we had 15 seconds to chug water and I'm vomiting water. And I'm like, I'm actually going to die. But you just keep pushing and you just trust the process. And not immediately, but probably 15 minutes later, I'm like, nothing can break me. I'm ready to go. What you got? And for the rest of the week, that was my mentality. And now for the rest of my life, that is my mentality. So train the brain. You're far more capable than you are.
This has been a very dynamic, a powerful show. Powerful show. Sir, how can we connect with you? How can we learn? How can we be inspired by you? How can we learn more from you and get on board this train?
We have tons of content on Your Mortgage at YouTube channel. So lots of videos. I got a podcast on there. I'm doing weekly podcasts. Obviously, the website, replaceyourmortgage.com. Facebook, Your Mortgage. We're constantly active and social with one another. So just reach out. Love to love on you and just share what I've got. And together, let's succeed.
Powerful. Check him out, y'all. That's replaceyourmortgage.com. Get in tune, get that free book. And if you feel like having that hard copy, get on Amazon. It's available on Amazon for purchase. But this is how you get to a better financial place. This is how you take your personal and your business to the next level. Mr. Michael Lush, changing the absolute game. This powerhouse. Thank you, sir. Thank you. And I want to say this to you publicly, sir. Don't ever give up. We need you. We need what you're doing. You are a game changer.
Thank you, sir. Thanks for having me. It was an honor.
It was an honor to have you. Yes, sir. And thank you all, my audience, for tuning in to the Gentleman Style Podcast Show. I hope this message has served you, and I hope this helps take your business, your personal life to the next level. So like I end every show, take care of your family, take care of business, and take care of friends. This is Gentleman Style Podcast Show, your favorite gentleman, and Mr. Michael Lush of Replace Your Mortgage, signing off. Love you guys. Bye.